Thank you, everybody, for coming tonight. I mean, this is so nice to see this crowd. I can assure you, I saw the same presentation last night. It was impeccable. I can assure you, you are going to like it as much tonight as the folks last night did. But in all seriousness, thank you. I feel like I want to do that Travis Kelce dance. For those of you that don't know him, it's Taylor Swift's boyfriend. And he plays football and he does a dance. But I've been talking to a couple people and they said, you remember a few years ago when the market was really down? I said, yeah, I do. I said, do you have to really bring that up? It's a nice night tonight. The S&P made 4 record closes in a row, so we love having you here on days like today. It's really, really nice. But thank you for coming up. This is a new venue for us. The 1863 Club is brand new for the Saratoga Racetrack. Just literally, there is the racetrack, and we got the Belmont coming in June, so that'll be exciting. I know that the hotel rooms, when they used to be $700, $800 a night, are now $4,000 a night. So it's really going to be exciting for Saratoga. But you get to see this room, and I think we like it. We all said we're really impressed with this room. To get started, where's my thing? So we got really a great presentation. My folks, somebody said to me 2 days ago when I told them about it, he says, well, it must take a lot to plan it. I said, they've been planning it for weeks, and I mean weeks. And every year it just amazes me. This presentation tonight, I think, is the best we've ever done, the information that you're going to get, and I think you're going to like it a real lot. So let's get started, and we'll get the show rolling. Before we go any further, if everybody on your table, or if you're close enough to one of these TVs, scan the barcode on your camera with your phone. For the old-timers like me, you know, I learned you can literally sit in your chair and just kind of put the camera up there, and it focuses in, and then you hit the little yellow box, and it brings you to this slido.com, and put in the code, because we're going to have tonight be interactive. There's going to be some questions, and then at the end, questions and answers that you're going to be able to ask. But I think there's also a sheet on your at your place setting. So the agenda for tonight, we're going to obviously talk about the state of our firm and what's going on at Bouchey Financial Group, the economic outlook. Can the soft economic landing of 2023 continue? I don't think there's anybody in this room that will disagree 2023 was a whole lot better than 2022. Yes? Perfect. I couldn't agree with you more. The market outlook, portfolio perspectives, and then questions and answers. And last night we had some really dynamite questions. So the state of the firm. You know, as I stand here, and I'm blessed in many ways. We have 19 professionals. I mean, it's crazy. And we have, at the moment, 7 certified financial planners, 4 certified public accountants, which is really 5, 1 certified divorce financial analyst. Not that we want you to use Nicole's expertise in that area, but if you need it, she's really good at it. An accredited investment fiduciary, a certified private wealth advisor, which there's very few in the country. That's Harmony. And we actually have 2 IRS-enrolled agents. So we have a lot of expertise in our firm. Our service team. And if I can ask the service team to come up, actually, why don't everybody come up? Because then you can get back to your place that much quicker. I'd love to introduce our team. Our success, the service team is really a big part of our success. Angela Cesny, who's been with us 25 years. Unfortunately, Angela couldn't make it tonight, but she's literally going into her 26th year, and we love her, and the rest of the service team. So we have Andrea Gearing, Jamie Durkee, Shelley Vitor, my favorite daughter, Lauren Bouchey, and Angie Gavin. And the service team, I think you probably talk to the service team more than you talk to any of the others. So our service team is just amazing. So thank you. Thank you. Moving on, we have our investment and operations team. You know, the investments, I have a saying, we do a lot for our clients, but the most important thing we do for our clients is manage their wealth. When you put your trust and faith in us, we don't take it lightly, and we are really committed to that. And Ryan, I kind of, handed off the reins of leading the investment team with Ryan, and right now we got Ryan Paulo, who's over here, Ed Wilhelm and Dave Clark. So that's our investment and operation team. If you're looking at Ed, he's one of our newer associates, and he was the captain of the rugby team at Siena. I literally knew that because as we were interviewing him, I was literally on a plane talking to some English gentleman and bragging how I'm going to Albany. He says, "Oh, I'm going to Albany too. My son plays on the rugby team." I said, "Oh, geez, we just interviewed a young gentleman from the rugby team," and they knew each other, so it confirmed that Ed really is the captain of the rugby team. And then we have our advisory team. And, man, when I tell you I'm blessed, I'm blessed. So, over here we have Nicole and Paulo who are going to be part of the presentation. Obviously, over on this side we have Sam Macy, Harmony Wagner, Scott Strohecker, Katie Buck, and Vincenzo Testa, along with John, Ryan, and Marty, which I think everybody knows. And, Charles Schwab does a benchmark survey. They look at us with like 1,400 wealth management firms around the country. And year in, year out, we're always in the top 3 to 5% of firms, and it's because of everybody that I'm surrounded by. The success of our firm is because of the team that we have. We're at a point where, and for those of you that are in business, the hardest thing is human capital. How do you find the right person? And we're at a point where when we find the right person, we'll actually bring that person into our family, our work family, and we'll find a position for them because that's the most important thing. And we've done that recently. Katie Buck is our most recent. Marty met with her for coffee one morning, and her boyfriend was over in the corner making sure that Katie was safe. And, Marty's a nice guy, but Marty came back from the coffee meeting. He says, "You guys got to meet this person." And, we weren't sure what we were going to do with Katie, but that's how we think. When we find the right people with the right ethics, values, personality, we want to bring them in, and Katie is one of our newer colleagues as well. So, our leadership team, my leadership team, right behind me. John Millay, our Chief Operating Officer and Chief Financial Officer. Ryan, my son, who's our Chief Strategy Officer and Chief Investment Officer, and Marty, our Chief Wealth Advisor. These guys are the guys that really help me, really, It's a beautiful thing when you have people that are so close to you that you trust so much and help you lead. I mean, there was a day when I could do it by myself, but, as we grow and we want to make sure we take care of all of our clients in the right manner, it's nice to be surrounded by people that are smarter than I am and that really have the brains. So I'm very blessed in a lot of ways. So expanding the expertise, Scott Strohecker is one of our newest colleague, and he joined us last year. He's an IRS enrolled agent. We also are adding to our team. We have a relationship. Where's Chris Allard? Chris, stand up. Nobody will miss Chris. So Chris is a CPA, an IRS enrolled agent, and he's going to be helping our tax team this year with a lot of tax planning for clients. And as I said, he's bigger than life. I'm always looking up to him. This past summer, we kind of kept it quiet, but we actually acquired a small wealth management firm. There was a gentleman literally right next door to our offices in Saratoga, and he wanted to retire. He looked all over the Northeast, and we were right next door to him. And he did his homework, and we kind of brought his clients on board, and it worked out good. And that, as I said, that's something we really haven't publicized. And continue to invest in our human capital technology. These are the reasons why we're in the top 3 to 5% of wealth management firms in the country. I'm very proud of that. We've been named the best place to work last year again, both locally and nationally. Very proud of that. So, these are our future advisors. Last year was a special year for us. It started in June. Graham Strohecker, Scott, newborn, daddy for the first time. Look at how cute he is. And then another new mom, Sam, had Paige in August. And then Harmony had Celeste in October, her third daughter. Harmony actually comes back to work on Monday. So last year was a special year for us because, I mean, look at these. You just want to kind of hold them and, you know, and we're lucky because they come to the office and we do get to hold them. So it's a beautiful thing. So I had to put that picture up there. We continue to give back to our community. We really, truly believe in it. I'm lucky because everybody in the firm has the same vision of giving back to the community. We do so much around the community. You know, Marty's the president of the board at the Ronald McDonald House Charities, so we're down there cooking for the kids, and you know, that's just one of the few things that we do. But giving back to the community and being involved in the community is big. I continue to go to Stewart's and Walmart and to the bank to get cash and try to help people that I sense are in need. You know, you can tell when somebody pulls up at a gas station and they're just putting $10 worth of gas in. I'll actually go in and pay for a full tank of gas. Just little things like that makes me happy to give back to those that I feel can use some help. So this is something that the whole firm believes in. We're lucky to be associated with a couple, you know, Charles Schwab, which I've been a fiduciary now for 31, 32 years, and we've been really partnered with Charles Schwab that whole time. We don't get anything by being partnered up with Charles Schwab. We could be with Fidelity, Vanguard. Charles Schwab was the biggest and best back then. They still are. We're still with them. And you see a lot of First Trust investments in your portfolio. So I just wanted to say thank you to a couple of our strategic partners. Now, for those of you that remember 2 years ago when the market was bad and you wanted to take that plunge, our newest associate, can you see him right here? You know, Scott Strohecker. Scott, I mean, what a face. And, you know, he did the plunge. He was on the front page of the Times-Union this weekend. For those of you that want to take the plunge, don't. Scott's taking the plunge for you. And it looked like it was pretty cold that night, so we had to give Scott a little shout out. So I'm going to stop there, hand the mic to Nicole Goebel, who will take us into what's ahead for Bouchey Financial Group. And as I said, thank you for being here. Hopefully you enjoyed the food, the venue, and we'll talk more in a little bit.
Hello. Thank you, everyone, for coming out this evening. So we're going to get started with our first polling question. So as a reminder, you can sign up on Slido or scan the QR code. That's also where you can put your Q&A questions for later this evening. But what services do you value the most? So investment management, retirement planning, education planning, estate planning, tax or insurance, or all of the above? So we'll take a couple seconds. Okay. Thank you all for your participation. Wonderful. So certainly this is similar to last night's results where we had investment management leading the way with retirement planning second. So that's what's so great about our job, is that we get to work with so many different clients that have so many different needs. So we really like to think of ourselves as our client's personal CFO. So I know for all of you here, we manage your investments in some way, shape, or form. But we also work with many companies in the area, managing 401k plans and 403b plans. And that's another way that we can touch the community, because we're not only acting as the fiduciary for those firms, but those participants of those plans actually get access to our advisors for their participant meetings too. And we're really proud of that, because these are individuals who may not have access to a fiduciary advisor separately. So our team loves doing that. We also work with a lot of nonprofits. As Steve talked about, we love to give back to the community, and one way we can do that is helping to manage endowments for the nonprofits in our area. And there is, again, a different mindset around managing an endowment, because that's meant to go on for generations to come, right? Not just to get someone through retirement or to leave a certain amount to heirs. We work with many of you on financial planning. And again, that could be traditionally getting you to retirement, ensuring you have enough to sustain you through retirement, but also on interim goals like funding college or buying a second home. Tax planning and preparation is something that all of you who know me, that I'm a CPA, I love to talk about taxes. But really, it's an important part of what we do, because if it's something as simple as determining what withholding rate you should have on your distributions when you start living off your portfolio, or really determining, is there something you can do strategically to lower your taxes, we're here for you, and we do provide that to our clients. So as Steve talked about, the expertise on our team, we're really proud of in that area, because there's not many financial planning firms or advisory firms out there that have the expertise we do in that area. And executive benefits and stock compensation. So we've worked with many of our clients that have stock options, restricted stock, things that we need to plan around not only on the investment side, but also on the tax side. And we love to, again, offer our services in those areas. There's also a number of outside services that we don't provide in-house through our own expertise, but can help coordinate. So whether that's estate planning, something we feel is important to everyone to have the appropriate documents in place, and we can refer each of you to an appropriate estate attorney, again, to get that done, or work with an attorney you already have. Insurance needs. We're actually very proud. We don't sell insurance. Again, we have no conflict of interest, but we see there is a need for insurance, whether it's income replacement when you're still working, whether it's long-term care, property and casualty, which everybody should have, or health insurance. We want to make sure we're offering you the contacts we know and trust in the community to help in those areas. And last but not least, business sales and succession planning. I know Ryan's done a lot of work in this area, but really we have many clients who are business owners and trying to figure out that next step. Again, am I going to pass this down to someone within my family? Am I going to offer the opportunity for my employees to buy into the business, right? Or am I going to sell and I need some valuation work done to understand, what should I be doing to change things in the last few years of my career as a business owner to get this ready? So we can also help in that area. As all of you know, we like to use low-cost exchange-traded funds as our core portfolio, and we really believe in that. But we do recognize that there are some cases where clients come to us and have a more complex situation that we have to work with them on. So we're expanding our investment services, again, where needed. A client might have a lot of individual holdings. Well, we want to make sure that we're managing that tax efficiently, and we're also moving that towards our model. So direct indexing, which is something that I've worked at other firms for many years on, it allows you to actively loss harvest those individual stocks, manage out of a concentrated position. Again, that goes back to the employee stock compensation. You might have too much in your employer. And also customize the portfolio based on your values or, again, risk preferences. I use the example of I had a client that worked for a pharmaceutical company. They certainly didn't want any more pharmaceutical stock in their portfolio because they had so much exposure through their job. And outside bond managers. Steve's talked about it so much this year, how we've put individual treasuries in those clients' portfolios that it was appropriate. Well, we also have access to outside bond managers, whether that's municipal bonds to customize to your tax situation, corporate bonds, but again, pairing with outside bond managers gives us a larger universe to work with. So Women in Wealth is something that we started last year. It's something that Steve believes very strong in and has wanted to do for many years. And we really appreciate that he supported us and really coming out with a lot of focused content, an event, a webinar this past year, and really promoting that the female members of our team attend many different events. So some of the things we did last year, we did have an event, and there's a webinar on our website. So if you go to our website, there is a specific Women in Wealth tab. We've also been networking with a lot of female professionals, so both in the area at the Women of Excellence, Women's Business Council of the Capital Region, at regional chamber events, but also outside of the area. A group of us went down to the Investment News Women's Advisor Summit, which is a national event that was held in New York City this year. I had the opportunity to go out to Austin to the Dimensional Advisors Women's Conference to work with people that, again, have focused their careers in this area to ensure we're meeting the specific needs some of our female clients have, right, around longevity or less savings, or maybe being left in a position where they weren't handling the long-term or retirement finances, but had a loved one pass away. So what's more to come on Women in Wealth? Well, we want to hear from our clients. So if you have ideas, we'd love to hear from you. We're thinking about doing events maybe around topics such as estate planning, long-term care, charitable giving. These are areas that in my 24 years in financial services, I've worked with many of my female clients on. And we want to hear from you if there's something important to you you'd like us to present some content or partner with some experts on. Educating our clients is something we love to do. So as I mentioned on our website, we not only have our Women in Wealth content, but also content for all of our clients. So as many of you know, Steve's done the radio show for 29 years and allows us to guest speak on those, guest host on those shows as well. But that's something really important. Another way that Steve has given back to the community. I was talking to a client who said his friend calls in every week and continues to ask him, do you like working with Bouchey? but really, again, it's a way that we can educate the general public and answer questions, because we know that there are certainly people out there that call themselves advisors, but again, have a conflict of interest. So we want to make sure we're providing that fiduciary guidance out there. We have quarterly market and economic webinars and letters that go out from Steve and Ryan. And Ryan sends every couple weeks an investment newsletter talking about either a change in the portfolio or just what we're seeing in the market and the economy. We want you to know what we're thinking and that we're constantly working for you. But we also do monthly webinars and weekly blogs on other topics. Again, we want to make sure we're hitting the points that you're seeing in the media, and we're giving you facts about that, whether it's cybersecurity, year-end tax planning, financial aid and student loans. We even have a client portal tutorial on the website. So again, if there's something you want to hear from us on, feel free to let us know. And last but not least, we really appreciate that you refer us to people that you care about. We are often asked to speak to a client's child, sibling, parent, colleague, and we are happy to do that. Even if we don't yet know if they're going to be the right fit to work with us, we love educating our clients and generations to come. Right? I was just talking to the daughter of 2 clients today, helping her get set up with a Roth IRA and letting her know, hey, when you get access to that employer plan, I'm happy to look at those options for you. So this is something we really appreciate because, again, we want to make sure that really everyone that you care about is getting the financial guidance that they need. So thank you again, because your referrals are the biggest compliment you can give us. So I'm going to pass it off to Paolo, who's going to talk to you about the economic outlook. He's going to have a lot more charts than me.
Thank you, Nicole. So let's start the economic outlook by going back to the polls. So what were your thoughts on the 2023 economy, and is your 2020 forecast any different? We'll take a few moments. Get some of this data in. Looks like the early front runner is Okay, all right, that just changed. It's feeling concerned in 2023 and continuing to feel concerned in 2024. Let's see if that's going to get beat. And let's say it does not. All right, so let's hop into the labor market. And I want to start with the labor market because the labor market really is the foundational piece to a strong economy. So the first chart we want to take a look at is looking at non-farm payroll gains. So this is the job growth on a monthly basis, and it goes all the way back to 2021. And what we're going to see here is really robust job growth coming out of 2021 and into 2022 as well. But then job growth starting to slow down and get into a more sustainable pace in 2023. This is actually a healthy sign, right? When we think about the labor market, we're not thinking about a sprint race. We're thinking about a marathon. We need to get it into a sustainable pace, and that's what we achieved in 2023. We actually just got some further job data for the month of December that came out earlier this month, and that confirmed it as well, staying above that 3-month average of 200,000 jobs added per month. So that's a real positive. Now we want to take a look at labor force participation. This breaks up into two groups. The first, we have the prime age groups. That's ages 25 to 54, really the lifeblood of the labor force. And then we have 55 plus. And what we'll see, the common theme here is both drop off during COVID, but then a nice steady rebound by the prime age group coming out of COVID all the way to currently. And the positive here is we're actually seeing the prime age group participation rate higher than it was pre-pandemic. So that's a real positive. And that's much needed because what we could also see here is 55 plus not rebounding. So in order to continue the job growth that we've been seeing in 2023, we need to continue to see that strong labor force participation out of the prime age group. So if we have a strong labor market, that must mean we have a strong U.S. consumer. And where we first want to take a look at is looking at the consumer balance sheet. This is looking at the overall balance sheet of the average U.S. consumer. And what we'll see here is obviously assets are towering over liabilities. So from a general net worth standpoint, consumers in a great spot. Now, where we're starting to see some material effects is when we look at the two charts to the right. And we want to start with the chart on the top right. This is looking at debt payments as a percentage of disposable income. So how much of the average consumer's income coming in is going towards debt. And what we'll see, the chart goes back 40 years, and we're at 40-year lows. That's the positive here. But what we'll see is during the pandemic, that actually hits the 40-year low, and then we start to see some material, effects from inflation as that, kind of tickers up right, from 2022 to 2023. So again, inflation is showing some effects here. And we'll see the same with delinquencies. That's the chart on the bottom right. We're looking at three criteria here. We're looking at auto loans, credit card loans, and student loans. Now, student loans are, pointed in orange. Now they've lied dormant since 2021, and that's due to the student loan deferments that we saw during COVID. So, they did start back up back in October of last year, so naturally we'll see a tick up there. But where we really want to focus on is auto loans and credit card loans. Again, this is going back 20 years. We're in a very healthy spot, but we could see the tick up from 2021, 2022 to 2023. So again, showing some material effects of inflation. So here we are, 2024, still talking about inflation, looking forward to next year's State of the Economy where I could finally take out inflation out of these charts. But nonetheless, we're looking at two components of inflation here. The first is headline inflation. The next is core inflation. So headline inflation is really encompassing all areas of the market, and then core inflation is just looking at non-volatile aspects of inflation, so most notably excluding energy. So positives here, we've dramatically come down from the highs of inflation back in the summer and fall of 2022. And that's certainly a positive in the sense that, that's the sign that the Fed's doing their job by raising interest rates and bringing down inflation. Now, the challenge here is we'll see both headline inflation and core inflation above the Fed's target of 2%. We're sitting, just above 3% on both headline and core. And that's challenging when we start to think about where are interest rates going to go from here? So currently, we're sitting at 5.38%, as we could see at this chart. That's right in the middle of the Fed's target of 5.25% and 5.5%. But where we really see the bifurcation on this chart is we're seeing the Fed's forecast of where interest rates are going to go this year, and we're seeing the market's expectation of where interest rates are going to go from here. So the Fed, which is highlighted in blue, they're forecasting 2 interest rate cuts at some point this year. And the market is forecasting anywhere from 3 to 6 interest rate cuts at some point this year. And we took a look at the consumer, we took a look at the labor market, and both the labor market and the consumer are in a great spot. So where this is really going to come down to is inflation. If inflation continues to make strides closer to that 2%, then I could say the market, data supports what the market expectations are. We're going to see, anywhere near 3 to 6 interest rate cuts. Now, if inflation stays a little bit more sticky and above that 3% level, it's more going to side with what the Fed's expectations are, about 2 interest rate cuts. And where I really want to kind of sum this all up on is when we look back at 2023, especially the start of the year, every big economist was saying it's not if a recession was happening in 2023, it was when a recession was happening in 2023. And here we're looking at a chart. This is the NBER, that's the National Bureau of Economic Research. And they actually look at 6 criteria across the economy to see if there's any, real weakness that can predict if we were previously in a recession or currently in a recession. And the way that these heat maps work, and by the way, I love my heat maps, red shows contraction, yellow shows softening, and green shows growth. And what we'll see is, broad-based contraction during COVID. That was the quick recession that we experienced due to the COVID shutdown of the economy. But then strong growth out of 2020, 2021, and even in 2022. But then in 2023, some softening. And again, the softening isn't necessarily a sign for concern. It's a sign of sustainable growth going forward. And that's really, going to be a key driver for 2024. So the next part of the presentation, I will pass it off to Marty.
Thank you, Powell. Hello, everyone. So we're going to talk about, can we continue this soft landing that we saw in 23? Can we move it into 24? But before we do, let's look at where you stand personally from a financial perspective. Where do you think your spending is going to be in 24 versus 23? So are you going to be spending a lot more? You feel in a really good spot from a cash flow perspective? Or do you feel slightly more positive, so you're going to spend a little bit more? Do you feel the same as you did last year, and you think your spending is going to be similar? Or are you in the opposite category? Do you think you're more concerned about your cash flow, debt limits, how much you spent last year, so you're going to spend less? Or dramatically less? So right now, feeling reasonably good. So planning to spend the same as 24, 23? Let's give it a little bit more. Okay, so that looks like it's the strong winner. Now, so that is the same winner down at Troy as well, and I think with Paolo's question, it was the same as well. So everybody's thinking about the same on this topic. So whether you're flying and landing on the tarmac or whether it's the economy, everybody wants a soft landing, right? You don't want that bumpy landing right there. And just a reminder, soft landing simply means you have inflation moving to the 2% target. And last year, we had inflation go from 6.5% down to 3.4%. So really nice way trending towards that target. And then you want the economy to remain strong, the labor markets, production, everything to remain strong. That's a soft landing. But before we talk about where we're going to be as far as how that's going to continue, let's talk a little bit about why was everybody so pessimistic, certainly the talking head economists, not our colleague Steve Bouchey, but many economists out there were pretty pessimistic. And why was that the case? So this graph here is looking at a yield curve. So a normal yield curve is positively sloped. And all that means is when you get a 20-year bond or a 30-year bond, that interest rate is going to be greater than a 2-year bond or a 3-month bond. So that's the blue part of that line. Most of the time, that's positively sloped. But the red part is an inverse yield curve, right? And that's where we are right now. We have a 3-month treasury a 2-year treasury is actually greater than a 10-year treasury. And what you see is those gray bars are recessions that quite often those inverted yield curves occur right before the recessions. And actually 8 out of the last 8 recessions, you've had an inverted yield curve. So right now, we are still in an inverted period here. And so that's why if you're looking at this, it can be concerning from a correlation perspective. But I think it's important to remember that there are a lot of things that have changed over the last number of years as far as the Fed's involvement in the interest rates and everything. And it may not predict if there's going to be a recession this year. The other area that people were looking at and causing concern is with unemployment. So this is looking at unemployment over the last, since 1950, the last 70 years. And we see a lot of peaks and troughs. And with that, those peaks usually occur after the gray bars, which is recessions, and the troughs occur before. So, if you look at this, when quite often unemployment goes below 5%, quite often you have a recession that follows. And that's where we are right now with unemployment at about 3.7%. But again, I think it's important to look at across all these spans. You can have a period of time like you did back in the 1960s where it was 5 or 6 years where you had unemployment at a very low rate. So we could be a period of time like, I'll talk about the 1990s, we have good economic environment and low unemployment. So what drove the soft landing last year? So first and foremost, inflation decline, right? That's the important factor we discussed. The drivers behind that, one, supply chain issues were resolved. So remember that from 2020, 21, getting goods out in the market was very difficult. Those issues were resolved, which helped from inflation. Also, demand switched from goods to services. And that changed, allowed prices to drop, in particular in the goods side. Labor participation rates increase. So Powell mentioned having those 24 to 55-year-olds get back involved in the workforce. That was very good for lowering wage pressure. And commodity prices declined. And pretty much across all commodity prices, they declined or plateaued like oil prices did. So those factors were very important in declining, with inflation declining. Now you have to have a strong economy. So what drove that? In the third quarter of last year, GDP increased by 5.2%. And to give you some perspective, over the last 10 plus prior years, GDP was increasing around 2 to 2.5%. So to have GDP increase by the amount it did was great. And there was a number of drivers behind that. One is AI, artificial intelligence. Ryan will talk a little bit more about that, but really what's driving that is both the investment in AI and how companies use it. Electric vehicles, that is both cars being produced, but all the infrastructure with electric vehicles. That is very important and really a big driver behind that growth. Energy. People don't realize that the U.S. is a huge energy producing country. Right now, we produce 50% more oil now than we did in 1970. We produce twice as much natural gas right now than we did in 1970. Right now, 25% of our electricity is produced by alternative energy sources, and a lot of that technology is shipped overseas. And then, so you're looking at this. This is a big part of the growth. Infrastructure. There's going to be about $1 trillion spent over the next year on infrastructure. And then finally, manufacturing. So, manufacturing started leaving the country in the late 1980s, 1990s. Over the last 5 years, a lot of manufacturing has been coming back to the U.S. And to give you an idea, the amount of money spent for manufacturing, new manufacturing centers, 4 times as much as what we saw over the last 10 years. The other thing is the residential market, the real estate market. So you would think if interest rates are going to hit 8%, that's going to be a problem for prices, but it wasn't. Prices went up across the country by 6%, even with interest rates up at 8%. So a very resilient residential market. And then from just an earnings perspective, so in general, earnings were supposed to decline last year. Instead, they were positive. They rose by 1%. So all these came together to have that soft landing. So what do we need to have in 2024? So in general, you don't want the economy to be too strong. That could be a problem. So Paulo mentioned this. If you have inflation up over 3% or higher, you have a really strong economy, very strong labor markets. That could cause the Fed to pause in lowering rates or even raise rates. And it really would not be called what's called a hard landing, but it would push off a hard landing perhaps down the road. So that's really, it's too hot. You don't want that. The other side is too cold, right? If you have the labor markets and the economy too weak and inflation below 2%, that becomes problematic as well. In that case, the Fed will drop rates, maybe more in that 6 times range, and that's the hard landing that we're not looking for. The soft landing is the Goldilocks environment, right? Where you have everything just right. You have good labor markets, good economic data, and you do have inflation trending to that 2% target. So that would, if we can have that, you're going to have the soft landing continue. So let's look at it from a history perspective. I mentioned the mid-90s. This is a time period where you had declining interest rates. That's the black line. It's kind of flat or declining. You had inflation also declining, just like we're having it now. And you have unemployment declining. So this is that soft landing piece that we're looking for. But there are times in history as well when you look and you see, hey, there are situations where you have a hard landing. You have interest rates declining in the early 1980s. You had inflation also declining, but instead unemployment increases, right? So there are situations where you have a hard landing with the same sort of factors that we're seeing. The crux, the real key to this is, what does the Federal Reserve do? How do they handle the situation as they get the data in? Last year, they got it right. It worked very well. So they need to make sure that they're out ahead of it this year as well. So what are the other factors that can drive this soft landing? One is the amount of cash that's out there. So coming off the pandemic, we had $2.5 trillion of excess cash out there. Now it's being spent down, but you still have in the neighborhood of $1.5 to $2 trillion of cash. So what that means is, if there are people unemployed or if their debt ratios go too high, there is a lot of cash they can use to continue spending. Also, a big factor of this is the amount of new apartments coming on, right? So there's going to be about 700,000 new apartments added. And that's important because one of the big factors in inflation is apartment rental rates. It accounts for 33% of the CPI. And if you can go ahead and have all these new apartments come on, it's going to be very important. Of all the inflation last year, apartment increase in the rental rates accounted for 70% of that. So again, this may keep inflation low. Finally, the strength out there in the residential real estate market, also very important. So this is looking at units for sale. Look at that, it's amazing. In 2012-13, there were 7 million units for sale, now down around 2 million. So all this means is they really need to be building a lot more homes out there. So there's no bubble in the residential real estate market by any means. But we do have our challenges as well. So this looks at the interest rate increases that we've seen over the last 30 years. We're that green line that is so steep. So to give you an idea, over the last year and a half, the Federal Reserve has raised rates by 500 basis points. That's 5%. So we went from about a quarter percentage point up to 5.25%. And the problem with that is you don't really understand how that impacts things until about 12 to 18 months afterwards. So, if they stop raising rates in July of last year, 12 months later is July of this year, 18 months gets you into 25. We just don't know how it's going to impact everything as we move forward. In general, as we look at things, there's no concern like a bubble of 08, 09, of a stock bubble of 2000, but you have to look at the cumulative impact of things. One of the issues that exist out there is the commercial real estate. So with working from home, a lot of vacant real estate, especially in the bigger cities. There's $550 billion of commercial real estate debt that matures in 2024 that has to be refinanced. So that's going to be interesting to see how that plays out. Paulo talked about increasing consumer debt and defaults. Again, the consumer makes up 70% of the economy. You got to make sure that they're able to spend and they're not defaulting on loans because that becomes problematic. Of course, there's a whole litany of geopolitical concerns that could become more problematic. And then finally, I love this one, the unknown unknowns, right? So that's Donald Rumsfeld, Secretary of Defense under George W. Bush. It's basically saying, hey, listen, I can sit here and tell you all the things I think are going to happen, but there's a whole list of other things that may come up. So, how all this comes to play, this is what to see. I will tell you that in general, we're pretty optimistic as we look at the economy. It looks very strong. We see inflation continue to trend downwards. So we tend to probably be more in the camp that, that soft landing can continue in 2024. I'm going to hand it off to Ryan now. He's going to talk about the portfolios and the markets.
All right, great. Thank you, Marty. So let's take our final poll of the evening. What is your market expectation for 2024? Obviously, we had a great year in 2023, but what are we thinking for the next year ahead? And this will set the mark for where we try to get to this year as well. All right, so slightly bullish, maybe a little flat. Looks like it takes in most of the votes. That's great. Let's talk about it a little bit. One more poll, actually, straw poll. How many fans of Indiana Jones out there? 80s, 90s action movies. So sometimes navigating the markets makes me feel like Indiana Jones. And it's so true. I mean, there's so many risks that are out there on a day-to-day, week-to-week basis. Some real, some maybe headline-driven, but there's a lot of risks that we have to navigate as investors, and we'll talk about those risks and what's ahead. But before we look at 2024, let's take a quick peek back to 2023. So this slide is right from our presentation from last year, so I just want to revisit it quickly. We thought there would be a more of a paradigm shift last year. I thought, valuations would matter a little bit more for 2023. And as we saw, it was really all about the Fed. It was all about interest rates. Now, where we did get it right to a certain extent is earnings did matter for those growth companies, right? They had some strong earnings, as Marty alluded to. Overall, earnings were only up about 1%, really didn't support the overall market, but we saw the strength in the market really did come from those, those Mag 7 companies that did have slightly better earnings. We talked about no time to give up on diversification. So, for a 60-40 diversified investor, it was a great year to get back into fixed income. Great year to get back into bonds. We saw the 10-year Treasury go up to 5%. We'll talk a little bit about that. But diversification certainly helped. On the equity side, again, with the Mag 7 and their strength, not a lot of help on diversification with equities, but overall we thought diversification would be a good thing. We were optimistic with stocks. I mean, when everyone said there was a 100% chance of a recession, given where valuations were, given where the market was, we still continued to be optimistic, and that really helped out for 2023. And lastly, we just asked the question, what if there's no recession? Again, everyone was predicting a recession. Well, what if that doesn't happen? What does the market look like in that scenario? And we got to be ready for that. So let's look forward. There's three ways to look at markets, I think. Fundamentals, we're talking about valuations, technicals, and human behavior. When we look at valuations from a fundamental standpoint, valuations are a little high right now. They're at about 19.5 forward price to earnings ratio, so the amount you're willing to pay for $1 of earnings. At the start of last year, we were at about the 30-year average, was about 16.5. So valuations have gone up. The market did great. Earnings didn't really support those valuations throughout the year. So we think this year especially, we do think earnings are going to be really critical. Let's look at interest rates. Paulo talked a lot about the Fed rate, the Fed funds rate. So that's at 5.25 to 5.5. We're looking at right now the 10-year Treasury yield, which moves maybe a little correlated with what the Federal Reserve is doing, but it's not fully predicated by what the Fed is doing. And the 10-year is so important because it drives what our consumer borrowing costs are, mortgages, consumer lending. So it's really, really important. And as we saw in the beginning of the year, so it highlighted three important, I think, time periods in 2023. So we saw Silicon Valley Bank collapse in early March, and that was huge. I mean, one of the biggest top 20 bank collapse in a matter of days. We saw rates come down pretty quickly. A lot of fear of a recession, a lot of fear of an overall market collapse. So that falls in line. As the year went on, rates slowly started to tick back up, and you look in July. That was the last time the Fed actually raised interest rates. So you can see from July to October, rates on the 10-year, even though the Fed wasn't doing anything, moved from slightly over 3.6% all the way to 5% at one point in October. So a lot of movement in the 10-year. And then towards the end of the year, we started for the first time hearing the Fed and Jerome Powell talk about a dovish sentiment, meaning, hey, there was a chance for interest rates to come back down, a chance for the Fed to cut interest rates. And we saw to end the year, rates came down pretty dramatically. And so how does that affect stocks? Well, interest rates have had a huge impact over the last 3 years. Back in 2021, we had relatively stable on the 10-year Treasury. Stocks were up almost 30%. Last year, as you remember, the Fed was increasing really quickly, and the 10-year was going up as well, and we saw the markets down about 20%. And then this year, that first half of the year, had some stability. It was moving up and down, but relatively stable. Markets were up about 16%. That third quarter of the year, when we saw rates really go up after the Fed's last hike, rates were going up, stocks were coming down. And then to finish the year, we had a great strength in the stock market as, again, those rates came down, stocks went up. So interest rates had a huge, huge impact on the markets for the last couple of years, especially in 2023. Now let's talk about U.S. equities and international equities. It's a question that comes up often. We're currently invested in only U.S. equities, and why is that? Well, when we look at the last 20 years, 20 years ago was the point, it's in the diamond of where these countries were. So the U.S. is on the right, you got China, Japan, Hong Kong, and all through the list. When you see the growth of U.S. stock market, and this is the total stock market size, the U.S. stock market's at about 50 billion. The next closest, China, is about 20% of that or so. And you can see just how large the U.S. has gotten. So why wouldn't you want to invest in those U.S. companies, those great technology growth companies? And we see the impact, especially in a global economy that we live in. Looking ahead, okay? It's not just about today, it's always about looking ahead. The black line is the United States. So we're looking at the population expectations for the next 30 years or so, 25 years. The U.S. is the only major market, outside of maybe India, but the three other big ones we have here are Europe, Japan, and China. And look at the growth expectations for the U.S. versus the declining. To have a robust economy, to have a growing economy, you need to have the demographics to support it. And we can see in terms of what the expectations are right now, U.S. has the best expectations for that growth to support a strong economy. Let's talk a little bit. It's an election year. I know every 4 years or so we have these conversations. So this chart is great. This chart takes the last 70 or so years and averages what the stock market did in each of those election years. So about 18 separate election years. And what we see is, believe it or not, those years tend to be pretty good. I know there's a ton of headlines in talking about the uncertainties of the election cycle and how that can be, problematic for the stock market. Well, historically speaking, it's actually been pretty good for the stock market. Will that continue? I mean, who knows? But I don't think just because we're in an election year, and there are a lot of uncertainties, although, I think when it comes to the election right now, we have two candidates that have already been president before, so at least we sort of know what we're getting. But it does strike a lot of fear in investors. But again, historically speaking, I don't think there's a lot of fear. And again, this is a quick, it's a great snapshot of just looking back, for the last 100 years or so. It really doesn't tend to matter whether it's a Democratic president, a Republican president, the stock market moves forward. Corporate America is really, really resilient. I know there can be some disruption in Washington, but again, corporate America tends to be pretty resilient through these times, and we think that's going to continue. So let's just talk a little bit more of, the markets right now. We think that there's a lot of catalysts for growth in the market, so let's start looking at it a little bit. Last year was a pretty weird year when it's all said and done, where you had 71% of S&P 500 companies underperformed the S&P. You see that on the right-hand side. This goes back about 25 years. That was the biggest percentage of companies that underperformed the market that we've seen in the last quarter of a century. That's odd. That usually doesn't happen. But when we look at today, we're seeing more what they call market breadth. We're seeing more expansion within the market. On the right-hand side, I'm just going to focus on those two lines. We have the NASDAQ and the S&P 500. For both of those, we talked about fundamentals before. This is more of a technical analysis. So both of those indices in major parts of our portfolio, the NASDAQ, we have 81% of companies that are above their 200-day moving average. The S&P 500, we have 76% of companies that are above their 200 moving day average. That's a good technical indicator that there's strength in the market, and that could be a catalyst for further gains within both indices, and I would say the overall market. A Fed pause. So let's talk a little bit about the Fed and the impact on the market. So in purple are stocks, in blue we have bonds. The left-hand side of this chart is a tightening cycle. That's when the Fed is increasing interest rates. We think we're past that. We don't think that the Fed is going to hike rates again. So let's focus on the middle and the right-hand side of this chart. So the middle is a pause cycle, which we believe we're in. The Fed last raised rates in July. So we feel this is kind of a pause cycle before they cut rates at some point. It's a really good time for stocks and bonds. And we saw that. We've seen that to end the year. We're seeing it, the last few days with all-time record highs. That's a good time to be invested. Easing cycles, as you see, maybe a little bit scarier. We see stocks pull back a little bit. But to Marty's point, we're in a little bit different of an environment today where typically the Fed is lowering rates because we're in a recession. They're trying to stimulate the economy. The Fed's not really trying to stimulate the economy at this point. If they cut rates, it's going to be more to just get to a more stable position because inflation has come down. So I think it could be different this time, but while we're still in this pause cycle, I think it could be really good, both for stocks and for bonds. Let's talk about investor sentiment a little bit. So I love this quote by John Templeton. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And what this chart shows is that we are far from either euphoria or optimism. So the light blue line, like the teal line, is the actual investor sentiment. The dark blue line is what's the estimated investor sentiment would be based on current economic conditions. And as you can see, since COVID, before COVID for the 15 years or so, those lines were pretty much right along with each other. Since COVID, getting a few months past COVID, obviously, but economic news and data has been pretty strong. Like the economy is doing pretty well right now, but consumer sentiment is far, far from those levels, which we haven't really seen before. But the good news, too, is over the last 2 months, we've seen consumer sentiment jump suddenly in some ways. By the most it's jumped in 20 or so years. When you look at the history of that tends to be, again, a good catalyst for an extended bull market. So we think that's a good thing. And lastly, we talked about how much cash is on the sideline. So this is showing how much is in money market funds today. And with money market funds yielding around 5% or so, a lot of people have put money there, and we're at about $6 trillion of assets there. If the Fed starts lowering rates, and those money market rate of returns are going to come down with that, or the yield is going to come down with that, what do investors do? Do they keep it there as rates are coming down to 4.5, 4, maybe under 4? Or do they reallocate it somewhere? Do they put it back into the stock market? So we think with all the dry powder on the sideline, again, that could be a catalyst for growth. So we get a lot of questions on AI, so I want to just talk a little bit briefly about it. So I took a lot of this data from a global C-suite survey. I think about 2,500 companies participated in it. So just read through it. 49% of CEOs say their companies are unprepared to adopt AI and ML, machine learning. We're seeing some short-term headwinds. As much, a third of companies are planning to spend more on AI in the next 6 months, while about a third are planning to spend less, which is interesting. Less than 50% of organizations are utilizing the technology. 16% are in pilot programs. 39% have yet to start or research it yet. One of the biggest concerns, they say, is security and privacy. And I think with all of our data, whether it's business-related or personal-related, I think we all feel that lately. But what came out of it, I think it's going to be the fastest growing for future job roles. It enhances human potential, and that's a huge catalyst for the economy. So how are we looking at it? Well, again, we're still in the infancy stages here. This is really, really early in this technology. There's going to obviously be big winners, but there's going to be big losers as well. And it's going to be hard right now to really predict who the winner is going to be and who the losers are going to be. Could be huge for economy. I think, in terms of the job growth, that's going to be really a productive worker, leads to a much, much stronger economy. That could be a huge catalyst. Again, catalyst for the next phase of the bull market. We saw it already in 2023. The excitement, the anticipation around it, big driver for those large cap growth companies. We also need to think about, what are the other beneficiaries going to be? Who are the other companies that maybe you're not thinking about? We think, one sector, one area that could be a big benefactor is healthcare. I think it could be huge. The other thing to remember, you think about the biggest technology companies today, the ones that are using, the growth of the dot-com boom back in the 2000 timeframe. a lot of those companies weren't thriving. They may not have even been around back then. So we think some of the winners, may not even be companies for a few years, a few decades really. So again, it's really, really in this infancy stage. And so just overall market outlook, as we said earlier, valuations are a bit high right now, a bit frothy as they say, but I think for this year, earnings are gonna matter. It's important to think about as we manage the portfolios, having what we would call an all-weather portfolio. As we said, there's always going to be risks out there. We're optimistic. We think there's a lot of catalysts for growth, but there's always risks. So we want to make sure we have that all-weather portfolio that can do well in up markets, but also maintain in a down market. Interest rate impact on the markets. We think, even though the Fed is talking about cutting rates as their next move, we think there still could be some pressure, as that 10-year, still some pressure of going up. So we'll see what happens. We like quality factors in our equity model. Strong cash flow, growing dividends, return on equity. Those are all important factors. We think those companies will do well in this environment, maybe a little slowing of an economy. And we'll look to add, longer duration and maturities to our fixed income portfolio. Continue to be overweight U.S. equities. We, like U.S. equities versus international, as you could see. We're not, from a portfolio perspective, looking to make any major changes or worried about, the election coming up. And there's plenty of reasons to stay optimistic. I saw this quote the other day. I really liked it, so I wanted to share. But bears get attention, bulls make money. We hear all the negative headlines, but when you have a year like last year, you want to be invested. So with that said, I'm going to turn over for just a few more slides.
Thanks, Ryan. So I'll just pause for a second to thank everybody because, Paulo and Nicole, two of our senior advisors. Nicole's a CPA, certified divorce financial analyst, and also our director of financial planning. Paulo is a CFP, certified financial planner, and our portfolio strategist that helps Ryan on the investment side, and then, obviously Marty and Ryan. I think tonight's presentation was probably as good as we've ever had. So let me round it out. These are what these guys laugh at me because I said, are you going to put my favorite, last year they didn't put my favorite slides in. I said, come on, guys, after 34 years of, come on, put my favorite slides in. So these are my favorite slides. And I like to just point this out. Marty kind of alluded to the fact that I was not one of those that believed we were going into a recession. I was public about it. I kind of set the tone in our firm that listen, us going into a recession, I just didn't buy it. And there was a lot of people that were really fearful. And when you think about the market bottoming out in October 2022, I remember I had a client that called me the summer of 2022, and 2022 was one of those years. I mean, the market was really only down at the end of the year almost 20%. At the low point, it was down 25%. And that kind of comes with the territory of investing. But this client called me and said, "Hey, Steve, I can't lose any more money. I just want to sell out, and when the market recovers, we'll go back in." I couldn't get through the phone line fast enough to just say, shake them, because I always promise our clients, before I let you shoot yourself in the foot, I'm going to be shaking you and shaking you hard. And I said, does that even make sense to you? We're going to sell out now when the market's kind of in a down position, and then we're going to buy back after the market recovers. And I said, and you haven't lost anything yet because you haven't sold. It's all on paper. Volatility comes with being invested. And as you saw from the slides, especially with Paulo, Marty, and Ryan, about interest rates, I mean, bonds, 3 years in a row almost. We had 3 years where bonds lost money. Finally, in the last few months, last 2 months really of last year, bonds turned it around, but they were on track to have the third losing year that they had. So volatility comes in all shapes and forms. Bonds, stocks, real estate, commodities. There's a lot of risk in different asset classes. You need to understand the asset classes that you're invested in, and you can't listen to the bad news bears. I've had some of you in this room, I've sent our IT people to your home to put parental controls on those financial news shows so you can't watch them. And that's why we do that. But this is one of my favorite slides, volatility. And believe me, the stock market is up more than it's down. Over the last 44 years, positive returns, 33 years. The average high to low, peak to trough, about 14.2%. Volatility comes no matter what. The stock market, I guarantee you, will go down at some point, and bonds as well, and they always come back and make new all-time highs. And we sit here today at the S&P at another new all-time high. Real quick, it's time in the market, not timing the market, and I'm not going to go through each one of these, but, the green bar is stocks, the blue is bonds, and the 60-40 portfolio, which a couple years ago people thought were dead, and as Ryan eloquently pointed out, it wasn't dead. Diversification made sense last year. So you got a 60-40 portfolio. Since 1950, your average return in stocks, 11.2%. Your average return in bonds, 5.5%. The 60-40 portfolio, 9.3%. And you can see the good years and the bad years. That's what this is showing you. So you can't be scared when you get a year. And going back to 2022, it wasn't that bad of a year. And we got a lot of emphasis in NASDAQ. It's one of our core holdings. NASDAQ was actually down 33% in 2022. The S&P was down 19.4%. But our clients know, because we really educate them that, we believe in technology. And I always like to say, until the day that I'm really mentally incompetent or dead, hopefully we'll always be overweight technology, because I believe in it. And that's part of the will, Ryan, and the inheritance. But I do believe in technology, and I'll take those years. We'll explain to our clients, a year like 2022, when maybe we're down a little bit more than the market, it's because of technology. And then you look last year, technology was up huge, and we'll take those ups and downs with a well-diversified portfolio. And this is one of my favorite slides that I just came across. Think of all the bad news over the last 5 years, reasons not to invest, and the market doubled. I mean, whatever it is, whatever you're looking at. And I'm going to finish out by saying, over the last 15 years, so go back to the Great Recession, the financial crisis, the market kind of topped October of 07. So this takes into consideration 2008 through last year. Your average return in the broad stock market was about 15% a year in, year out. That includes losing 50% from October 07 to March of 09. It includes losing 34% 4 years ago, just about now, when COVID hit us. And in 2022, when the S&P was down about 20%. 3 recessions, a lot of negative headlines. If you hung in there and you stayed invested, and I ran into somebody, I went to a 50th anniversary party, and this gentleman is not a client. I said, how you doing? And he says, I had to work a little longer than I wanted to. And he worked well into his 70s. I said, why? He says, well, you remember, that when everybody lost their money 15 years ago? I said, yeah, our clients didn't lose their money other than for a short period of time. He says, well, I got out and I never got back in. My advisor really was as scared as I was, and my heart just broke for him. We won't let that happen to our clients. I always like to say we get paid the most to take the emotion out of the decision-making process, because we're thinking with information and rationally, and it's only human nature that you think with your heart, especially when there's down days, weeks, months, or years. So you look over the last 15 years with 3 recessions, your average return year in, year out, it's about 15%. NASDAQ, and I bring that up because it's one of our core positions, 21%. So we'll take a year like 2022 when we lose a little bit more, because over those 15 years, we made a whole lot more. Bonds, about 2.5%. And we're not here to push stocks over bonds. Over time, stocks aren't as scary. Bonds belong in portfolios depending on your tolerance for risk. So that's kind of the last 15 years, and that's a good benchmark. And then gold, about 4-5%, and international investments, about 7%, compared to 15 for this great country of ours, the USA, the S&P 500 index. And that's one reason why we've been underweight international investments forever. We've been out of them for years, and right now we don't have any intentions of getting back in. I think that slide that Ryan showed that. So all in all, stocks go up, stocks go down. We learned over the last few years, bonds go up, bonds go down as well. And hopefully, you continue to put your trust and faith in our ability to manage your wealth. I always ask you, are we meeting your expectations? That's what means the most to all of us. Are we meeting your expectations? So I'm going to finish before I hand off to John. Thank you for that trust and faith in our ability to manage your wealth. I can't thank you enough. It means the world to me, and we'll continue to work diligently. So with that being said, John's going to take us into questions and answers, and we'll go from there.
Thank you, Steve. What a great job by all of our presenters. And, with all that great information and thoughtful insight, I'm sure many of you have questions. We're using Slido to collect those questions, and I can see many people have already entered them. I will say this is going to be a brief session. Don't worry, we're not going to keep you here until 11. So if we don't get to your questions, certainly don't hesitate to reach out to the firm, talk to your advisor. We certainly want to answer any question you have. We're going to start off with a question, Ryan, that goes right to our portfolio. And, cryptocurrencies certainly have had an interesting run. And last year, certainly there was Sam Brinkman and FTX caused some issues. But just in January, just a few short weeks ago, SEC approved the first spot ETF on Bitcoin. So certainly the question that a lot of folks have is, should they have crypto in their portfolio? So this is specific to our portfolios. What's our position on crypto investments?
So I think when I think of crypto, is it working? Yeah. When I think of crypto, I think of three factors of trying to just think about it as an investment, right? So in value, what's the intrinsic value? And much like gold, there really isn't a intrinsic value on crypto assets. It's speculative, but there's not a lot of intrinsic value. So it's hard to determine a appropriate price. Stability, you think about it as what it's meant to be, type of currency. Well, it's super volatile still, not a ton of stability. And what are the use cases? As it's developed and emerged, there's probably a few more use cases, but it still hasn't, taken on a huge, segment of the population in terms of being used. We saw the spot ETF come out earlier this month. A lot of folks speculated that was going to be, a huge boost, right? You could actually own an ETF that physically owns crypto, and we've seen in the last 2 weeks or so, I think it's been maybe about 2 weeks. The price has come down. As of yesterday, the day before, it was around down 10%, I think, maybe a little bit, maybe 15%. So I'm not exactly sure on what it's down, but it hasn't been this catalyst for it to grow up. So again, I think it's a highly speculative asset class. I think it's really hard to put a value on it. So, from our portfolios, not really something we're looking at to add to it. I wouldn't be comfortable adding it to the portfolios. However, people ask about it. Obviously, many investors have made a lot of money through crypto. I'm not denying that. But if it was something you wanted to add 1-2% to your portfolio, I think that would be reasonable. But it's not something we're looking to add to our model portfolios at the time.
Thanks. In Nicole's section, she talked about all the different services that we provide, and financial planning being one of the important ones. I think, Marty, I'll have you take this question. And this is a question that comes up a lot, and several versions of it tonight in the Slido app is, should I take my Social Security at 62, 65, or 67?
Okay. Great question. So, this is definitely one of those questions, it depends, right? It really does. There's so many variations of this, and, if you're married, there's even more iterations. There used to be a lot of strategies you could use to take it, and the delay and everything. All those strategies have been moved away. So the basic way to view this is, if you're married, if you can have one of you wait as long as you can, which age 70 is the last age where it keeps going up, goes up by 8% every year. If you can have one of you wait until age 70, that way you're going to have that higher amount in your household, so that if something happens to that person, it goes to the remaining spouse. And then, it comes down to cash flow. I always tell folks, if you want to take your Social Security at age 62 and that's important to you, go ahead and take it. There's nothing, we've never seen a financial plan work or not work depending on when you take your Social Security. So it really depends on cash flow. A lot of people say, hey, listen, I've worked hard, I want my money. The only other element is, if the break-even age is around 70 to 80. So if you have health issues, it does make sense to take it earlier. But beyond that, it's a discussion you need to have with us, and we kind of go through the pros and cons. But I always tell people, don't overthink it. We'll kind of give you some parameters to make the decision. But like many things in life, you can make it worse by overthinking it and stressing out about it. So.
In Paulo's section, he covered interest rates and what the Fed is looking at and what the Fed is planning to do and what the market is hoping the Fed will do with rates. A couple questions about, does that make 2024 a good year to buy a home or refinance?
Well, I'll take this one. I mean, listen, this decision is based on, it's a home, right? And, if you own a home and it goes up in value, fantastic. But really, you should be buying a home in any capacity based on, you need that home, right? That's where you want to live and that's what you want to have. I mean, certainly prices are high, and with interest rates coming down a little bit, but they're still kind of high, it's going to be expensive. But if you can afford it and that's the home that you want to buy, then go ahead and buy the home. But just appreciate, when you look at this, you got to make sure it works, for your finances. Really be considering that. The thing to appreciate, and I showed it in that slide, which is, I don't see a situation where housing prices drop dramatically. There's not enough homes right now. So, if rates do drop, housing prices could go up even more. So again, a lot of these decisions are more, what is your overall financial picture? How secure is your job? And if you really feel like, hey, our family's growing, we need to get a better home, and by the way, we can afford this home, then go ahead and do it. So it's really a financial decision of where you stand, more so than worrying about where prices are going to go.
I just want to piggyback on what Marty said. Interest rates, we never know where they're going. And over the last few years, we saw really a drastic change in interest rates. I think Marty's slide showed just how steep the rise of interest rates went. We had 11 interest rate hikes. Ryan pointed out that the last one was summer of last year. And why does the Fed raise interest rates like they do? When we go to Stewart's and our milk and bread and gas costs us a little bit more, when we get our professional services or our rent goes up, that's inflation. And what the Fed does is it taps its foot on the brakes to slow down the pace of inflation, where money isn't as easy for consumers to get. The consumer makes up 70% of the economy. And that means that if the consumer is out there having the time of their life, and remember, go back 15 years ago, one of the reasons we got in trouble, consumers were using their equity in their home as like an ATM, and it was terrible. Something that we never ever thought of, never advocated, because that's like the safety blanket of your financial plan, having that equity in your home. So the Fed actually taps their foot on the brake by raising interest rates so that it slows down an economy that's going too fast. The Goldilocks economy is when things are just right, not too hot, not too cold. So the Fed this year, right now we're in the middle of a pause, and I'm pretty sure in my heart that the Fed will be lowering interest rates at some point. But you have to remember, the Fed hasn't been true to their word, and I've beaten the Fed up enough on the radio and with conversations with clients. I go back a few years ago when really the Fed said inflation was transitory, temporary, and we all know that. And I said the reason why they did that was they don't go to the grocery store. They don't fill up their cars with gas. They were kind of out of touch with reality, whereas all of us, we knew we were paying more, and inflation touched 9.1%. That was huge. And now it came all the way down. We're lower, near 3%. but they felt that inflation wasn't here. They also said that interest rates wouldn't go up until after 2023. And it's not because they're dumb. It's because inflation is a moving target. And that's what's going on right now. I think Ryan and Marty pointed it out. We don't know what's going to happen with inflation. But inflation is a moving target. So the Fed is looking at all the data that they get. And you may see them make changes that surprises us. But at the moment, it is in what we call a pause mode. And if you do buy a home, or you're counseling your children or grandchildren to go out and buy a home, probably an adjustable mortgage makes sense, and they can refinance it. So that's really what's going on with interest rates, to piggyback on to what Marty said.
Great. You know, Ryan, you talked about artificial intelligence, and certainly AI was the buzzword, right, in 2023, and certainly was identified as one of the catalysts of what was driving the recovery of tech. And so many investors say, is it too late? Did I miss the action? So I guess, what are the firm's plans to invest in AI other than just investing in QQQ?
Yeah, it's a great question. So I think right now, part of where we see most of that growth would be in those, again, large cap growth companies. I mean, you see it. I think Microsoft is, well positioned just because of their enterprise and their scope and what they can do. Obviously, we've seen it with NVIDIA. That's a big part of QQQ. Google. So, QQQ is kind of a cop-out, I think, answer, but it's kind of true right now. Again, I think we're so much in the infancy stages. As I said before, we hold healthcare, and part of that again is we talk about that all-weather portfolio. Healthcare does really good as a defensive sector in volatile markets, but we think that there's a lot of growth opportunities in the healthcare market because of AI. Frankly, I think it's going to be years, if not decades, to really see some of the true winners from this AI growth. And one final point I will say, so there are ways to get, even through ETF, there's AI ETFs that are out there already. But I was looking at some. I'll use this as an example. One of the larger ones that are out there. So some of their, NVIDIA is a big holding, but some of their bigger holdings are Intel, Adobe, some of these companies that will benefit from it, but they're not those growth leaders that you think of. And as I've said, I think Microsoft could be a great growth leader from AI. They weren't even in that fund. So, there's opportunities to get into funds like that. As of right now, we're not really looking to add to the portfolio. Last year that fund was up the same amount as the S&P was. So with all of the hype and all of the growth we were seeing in AI, it really didn't benefit from a investment standpoint. So sometimes there's hype in the market versus what's actually happening in the market. So as of right now, we're not looking to add that to the portfolios, but I think we're still going to benefit from those growth companies. And when you look at earnings and earnings projections, large cap growth companies continue to be the leaders in where earnings are projected to go next year. So I still think, again, I think in the question said, except for QQQ, I still think QQQ is probably one of the better ones. Some of our quality factor holdings too, I'll just add this really quickly, that take into account earnings, growth, cash flow. Some of the biggest earnings in those positions that we hold are NVIDIA and Microsoft. It's one of the reasons why we like those areas, because we think those are good companies for this environment. So I'll add that to that as well.
Okay, we have time for just one more question, and this one I think would be appropriate for Marty. This one's from a business owner in the room who's, because of their multi-year contracts, don't have the ability to reprice as inflation runs rampant, and they've been hit hard, like many businesses, quite frankly, have been. So what's our outlook over the next 2 years for inflation?
Yeah, I mean, right now, I tend to think it's going to be a little more sticky. We saw it move up from 3.1 in November to 3.4% in December. The graph I showed you, the too hot, too cold, right in between. So we're going to have to kind of see how that goes. I think there's a big element. If we can get, the rental rates on apartments to go down, it's 33% of the CPI. It's a big driver behind that. And so I think if you can start seeing that go down, it's going to allow inflation to plateau and move lower. And again, that's going to allow the Fed to make adjustments. So, the only thing is, though, if you're a small business owner, you could be dealing with a whole different pricing structure than the CPI, right? So, I'm talking about a broad inflation index. In a particular industry, you could see a lot more. I don't know what the demand is in that industry. You could see a situation where prices remain high if you have a very competitive industry. So it's very industry specific.
Thanks, Marty. Well, I want to just take this moment to thank everyone for attending. I hope you enjoyed the event. Also want to note that Mazzone Catering provided the food this evening. Hopefully everybody enjoyed that. And they're also going to be providing cookies for everyone on their way out the door. So again, thank you for attending tonight. Appreciate it.